Hello, chart watchers, and welcome to this Monday, May 13th, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swenlin. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Well, market not getting off to a good start following last week's losses. We see the Dow Jones Industrial Average currently down 580 points, the S&P 500 down 65 and change, the NASDAQ down 245, and the Russell 2000 down 45 points, almost 3%. Russell 2000 lagging a bit today, but all of our major indices down considerably. 10-year Treasury yield back below 2.40%. This is not good news. Money continuing to rotate into the defensive treasuries. Volatility index up last time I looked about 27%. It's up more than 4 today, back above that 20 level. Technology, industrials, consumer discretionary, communication services, these are the aggressive groups, and they are leading to the downside. Apple and Caterpillar, two of the big losers today, the two biggest losers on the Dow, both of which have a lot to lose in this U.S.-China trade war. And you can see that over the course of the last 5 or 6 trading days, both of these stocks have really been tossed out by traders. All right, Aaron, it's the start of a new week, almost middle of May already. And wow, we got ourselves quite a market today.
Oh, indeed. I keep waiting for that bounce, but the volatility, you show the VIX. When we get readings this high, certainly caution is warranted.
Yeah, I think longer term, and I've got a couple charts I'm going to show on some sentiment. Of course, you have sentiment later today. It's going to be very timely because when you get into a market like this, I don't think the fundamentals matter. We don't have any economic news coming out today. There's no real significant earnings news. The market right now is just trading on fear. It's just hanging by every word right now between U.S. and China. Really, it's just kind of what we looked at 5 months ago. The market just, 600 points, who cares, just down 600. Been a rough last 6 or 7 days for sure.
Indeed.
Well, I tell you what, we have got a ton to go over today. Of course, we have our Monday setups as usual and a number of other things. So I have to say we just go ahead and get this whole party started.
Absolutely. All right, this upcoming schedule is looking pretty good. Tomorrow I'm going to be doing a workshop. I'm not quite sure what it's going to be on, but probably the PMO. I'll probably bring that one back for a little bit more discussion. Christopher Bretcher is going to be here on Wednesday. We, of course, have Talking Technically, our new segment. It'll be on Thursday. And then Friday, when Mary Ellen is here, what's hot and what's not. So big, exciting week. Today, of course, is an exciting day. Monday setups are going to start right after the technical news and headlines. Earnings Spotlight. We'll also be looking at, as far as the 10 and 10, our first symbol is going to be Black Hills Corp, BKH. And then finally, we'll finish off with the Decision Point sentiment update. So sentiment definitely pretty interesting right now. All right, let's get it started with technical news and headlines.
All right. Well, we didn't have any economic news out today, none of significance. So I'm going to start with the 10-year Treasury yield here. I just wanted to highlight this 2.39%. Let's just make sure we have the very latest. Yeah, still sitting down here, 2.394. You can see that the low back in March got down to 236. So we are not far from reaching that low. I think the combination of this U.S.-China trade conflict and the fact that there's just no inflation out there, I think the combination is really keeping folks in the treasuries and we're not seeing a whole lot of rotation from treasuries back into the equity market. Also, the volatility index was building even before the market topped. We saw, some of the fear beginning to pick up, and maybe that was a little bit of a warning for all of us that the U.S.-China trade deal was still in the wings, hadn't been done, and we still had to deal with it because that has been the big driver for the market to the downside over the last 6 or 7 trading days. All right, as far as earnings go today, we just have a couple of reports coming up after the bell. There was really none of significance this morning, and of course Friday after the bell, there's hardly ever earnings reported. So there wasn't really much for the market to trade off of in terms of earnings today. It was really, again, about the fear about the China trade war and trying to figure out, when we might see an end to that. As far as some charts to take a look at, there are a number that I want to show you this morning. And the first two I want to start with are the sentiment related. And again, Erin will go over sentiment later in the show and she'll give you her thoughts on that. But let's take a look first at the volatility index. Now, this is a 10-year weekly chart. And what I've done with the color coding here is anytime we get up into this really dark red zone, which is above 30, that normally coincides with some pretty significant selling. Now, this was 2010 and 2011. Of course, we were coming out of the secular bear markets. Still a lot of fear in the market. You can see even on these lows, the VIX only got down to about 15 or so. It just, we weren't seeing those readings down at 9.5, 10. The market was still very fearful. And so if we got any bad news at all, we saw the spike on the VIX and we'd quickly drop in equity prices. But as we started moving further and further into the current bull market, you can see that the volatility index dropped. And I've circled the VIX down here. When the VIX is under that 17.5 level, to me, that is nirvana for equities. That's when there's very little fear. It doesn't matter what news comes out. The market just seems to want to keep going higher. So I've shown you the way that the S&P 500 has moved during these periods when the VIX stays contained, for the most part, below that 17.5 level. And that coincides with all of these big moves to the upside, especially, like I said, once we got away from that bear market and we started to get to more normal bull market readings on the VIX, which is lower teens down to around 9 or 10, that's when we started to have some very consistent moves to the upside. But notice these spikes. And when the VIX spikes, I think, and there's a lot of traders that really like these volatile periods. I can't stand them. I think it's very difficult. You think you have it. And I thought there was a reversal on Friday. And then you wake up this morning, you got Dow down 500. That's what happens when the volatility is elevated. You can't predict how the market is going to react. Well, you can predict if there's not good news, it's probably going to go lower. But you just don't know whether that bottom is in, and then all of a sudden maybe we get a trade deal over the weekend, you gap to the upside. It just makes it very difficult for trading. And when you're wrong, you can lose a lot in a very short period of time when the VIX is elevated. And that's what a lot of these periods will show you. When we get up above that 17.5, 18 area, and we had John Murphy on last week, he said he looks at the 20 area, and that certainly could be supported here on a number of these charts. But when you start getting the VIX above 20, that's when you get these red areas. I didn't mark it over here, but you can see in 2018, these big drops occurred after the volatility index began to spike. So with a VIX in that 20 range, I think you have to be extremely careful. And if you're going to trade, you have to recognize that days like today are certainly possible, and you can be on the wrong side of a trade. And on both sides, by the way. I mean, last week, I think we showed how quickly the market can rebound when the VIX is this high as well. So it can go in both directions. But just wanted to point that out. The next thing is another sentiment chart, and this is on the equity-only put-call ratio. This is just a daily reading for the last 2 years. But when you see, and I didn't annotate this, but I think it's pretty clear, when you start getting these readings up at about 0.8 and above, that means there's more and more puts being traded than calls. It's telling us that traders are starting maybe to go overboard. And if you look back at some of these really high readings, you can see that they tend to coincide with some very significant market lows. And if you notice Friday, this is Friday, not today. I'll be interested to see how this is at the close today. But Friday's reading was at 0.8, which was the highest reading of 2019. And that was even after we had the recovery on Friday. So I suspect we're going to get another big move higher in this dollar CPCE today. And as this keeps going higher and higher, I think we're getting closer and closer to a bottom. The problem is if you're off by a day or two, the S&P 500 could be down another 5%. And that's what makes it really difficult to try to catch these bottoms and try to trade profitably in this kind of an environment. All right, a few other charts I wanted to go through today. Like I said, there was nothing in the way of earnings or economic reports really to talk about. So let's look at the XLU versus the S&P 500. Now, this is the defensive sector, and you can see here in May, money is rotating into defense. The utilities group moving back to the upside, not yet able to make a relative breakout above the March high, but getting close. The consumer staples has already made a breakout above this triple top. So you can see, again, money rotating into the defensive areas of the market after consolidating throughout last summer, when we finally broke out in October, we know what happened in the market when the market was getting defensive. So I'm not saying we're going to have this big drop, but I do think a lot more is possible when we start seeing this kind of behavior in the market. So you want to be careful and be protected. The XLRE, this is real estate. Now, this one, they definitely moved up relative to the S&P in the fourth quarter of last year when the market was weak. But when the market rebounded, real estate kind of held its own, partly, I'm sure, because interest rates stayed low. But now with the fear building again, you can see that real estate coming back into favor, on the verge of maybe another big relative breakout here. The XLY, XLP, this is a ratio I like to follow in the consumer space. Now, what really bothers me is when this starts going down when the S&P 500 is going higher. Anytime the S&P is going lower, I expect this ratio to go down, similar to what it did, in the fourth quarter of last year. Because as the market goes down, folks tend to get more defensive and money rotates into consumer staples relative to consumer discretionary. But nonetheless, it's still worth pointing out. You can see as long as this continues dropping like this, it's telling us that the market is in a risk-off mode. Transports versus utilities, same type of deal. Now, I was concerned about transports and utilities because we really hadn't seen much of a move back to the upside in 2019. We saw the decline in the fourth quarter, and again, that's normal. When the market is selling off, money rotates toward utilities typically, and transportation stocks, which are very economically sensitive, tend to move to the downside. So that type of a relative move in this ratio was not, really wasn't a surprise in Q4, but we really haven't rebounded that much. We weren't able to break above the February high, which was a little concerning, and now here we are rolling back over again. So this is one that I'm certainly a little concerned about. Looking at a couple of individual areas in the market today, retail. This is a big breakdown today in the XRT. We're now at lows that we had not seen since the second week of January. We were unable to take out that early March high on the strength that we saw in the market in April into the beginning of May, and now this move back to the downside has been pretty robust. All right, the Dow Jones Computer Hardware Group. Of course, this is where Apple is, and Apple clearly is one of the stocks that the market feels is going to be hurt by this U.S.-China standoff. And we saw it last week with a big drop. But this one is notable in the sense that we did break down below both our moving averages. This is a weekly chart. So we're now below the 20-week and the 50-week moving average. And in the past, I highlighted these 20-week tests during uptrends, which is what we typically see. But here, after breaking above the 20, we've come back down, and so far we're not holding it. I'd like to see a recovery by the end of this week, print a hollow candle, and get back up above that 20-week moving average. Otherwise, I think that is a bad look on the chart, something to keep in mind here. And then the last one I want to show you is the XLK versus the S&P 500. Now, yes, it's been a rough 6 days, but I think if we keep everything in perspective, this is a group that has been outperforming for quite some time on a relative basis, really since 2013. We do have pullbacks from time to time, but this is a group that's been leading to the upside. On a seasonality front, I think it's worth noting that technology, when we go back the last 20 years, you look at it and you say, okay, well, May goes up 0.7% on average, June's down, July's back up a little bit. But when we compare it to the S&P 500 on a relative basis and look back, you can see May not bad. June, though, is horrible, only up 26% of the time versus the S&P. July's up a little bit more, but you can see there's just not a lot of outperformance beginning in April through July in technology over the last 20 years. Instead, what maybe you might want to concern yourself or look at would be the healthcare group. Healthcare has been a big outperformer versus the S&P 500 in May. Also in June, you can see it's a great, June is a great month for healthcare stocks on a relative basis. And when you take a look at the sector summary, this is the last thing I want to show you. If we pull up the sector summary and just go back to last week, you can see healthcare kind of middle of the road, not down at the bottom with some of the other groups. And even on a 1 month basis, still sitting in the middle of the road. So maybe we're starting to get a little bit of that rotation into healthcare. All right, Aaron, upgrades, downgrades, what you got for today?
All righty, let's go ahead and get started on this. I do have a couple for us. I'm going to start off with the upgrades, and our very first one is BDX, Becton Dickinson. And today it was upgraded by Barclays from an equal weight to an overweight, and their new target is 266. So they're looking for a breakout above the high we had back here in September, October. Getting ready to hit some pretty important short-term support. You can see where we stopped off here last time around 220, and it came down. It looks like it might have tested that area and wants to head back up. As far as a decision point trade would be concerned, I wouldn't get involved, mainly because of this top below the signal line, and of course it is in negative territory quite a bit here. Also, you can notice the OBV dropping very quickly on all of this negative volume that we have seen in the past week. So interesting upgrade there. Merck was upgraded today by Atlantic Equities from a neutral to an overweight. And this one I thought looked pretty good. Of course, I'm not thrilled with the top below the zero line for the PMO, but I think there's there might be some interesting stuff going on here. Mainly, I was looking at this flag that was forming, and it found that support back here mid-April, and we're pulling back after testing the lows we had back here, the high back here, to form this flag. If the flag does execute to the upside, I calculated something like an $87 minimum upside target. I just am a little bit concerned about the fact the PMO is turning down the way it is, but it makes sense. Momentum is starting to be lost here. Texas Roadhouse was upgraded today. It was upgraded by Robert Baird from a neutral to an outperform. They have moved their target from $61 up to $65. So they're looking at about this range. I would say that the area to be concerned about is going to be that $59 where we have these lows. That's going to be probably the first test of overhead resistance. But this looks pretty good. It all is on the upgrade. This is a bullish ascending triangle, and the expectation is a breakout above the overhead resistance at the top of this triangle. You've got the PMO. It's stopped. It's trying to turn back around in very oversold territory. You notice an improvement on OBV and Scooter. The next step is to try and close this gap that was formed back here at the end of April. Seems possible. I always worry when you've got EMAs configured the way they are, but this might not be a bad shorter term play. You can see that this low in December is right where overhead resistance is. So if we can pop up above that and then start to fill the gap, of course, that would be good news. And it appears that Baird is thinking that we will see that breakout. All right, Hilton today was downgraded. We're going to move it on these downgrades. Berenberg downgraded Hilton from a buy to a hold, so they're moving into more of a neutral position. And their target had previously been $83, but they have decided to move that to 94. So they're still looking for upside movement here, but not that much, I would say. I like the PMO, except for the sell signal, of course, but we saw it rising. Right now, we're looking at a descending wedge. That's a bullish pattern. The concern, of course, is that right now we are trading below that the area of support that was formed by that April top. So that could be a little bit of a concern. But the expectation, honestly, is an upside breakout here. But with the PMO getting that sell signal, certainly it would be a little bit more on the risky side. Invesco downgraded today by UBS from a neutral to a sell. So we're not moving into a neutral position. We're actually moving into a short position here. And you can see that that rising bottoms trend line has been broken to the downside. You've got a PMO sell signal in overbought territory. I have to say, I certainly am on board with that particular downgrade. Finally, our last one is ExxonMobil. They were downgraded today from a buy to a hold by HSBC. Now, it does seem to have found some support here, and they moved it not to a sell, but into a hold position. I would look for a little bit more action here across sideways, more consolidation, waiting for that PMO to start making its way back up. You can see the scooter's already trying to do that. OBV is still not where you want to see it, declining tops on declining tops for the price. So at this point, I can see the neutral. I would be looking for this support level to hold, but I'm not so certain we're going to get that much upside movement. All right, that's it for upgrades, downgrades. I did want to mention that Pinterest today, 9 different agencies initiated coverage on Pinterest. So I just wanted to let you know about that as well. All right, time for Monday setups. Let's see, how did we do last week, Tom?
I think you ran away with it.
I did, huh? And everybody, I think mine was the last place pick too.
Well, utilities are not going to be, normally are not going to be too many fan favorites.
Right.
This environment, it was definitely a fan favorite.
Yeah, it's definitely the place to be. All right, well, let me share my screen and see if we can get a few of get those two up on charts so we can look at them. So we had FE. So I'll start with that one. So yeah, I got it. What was it? 41.88. It is up.
Yeah.
Not bad. Not bad. It looks like it's breaking out. So I would have to say if I had it, I would be holding it for sure.
And you've got the overall market probably down. I don't know what it's down now since last week, but probably, let me look at the S&P real quick. That would be down, what, probably close to 5% since we were doing this last week, or maybe 4%. So FE, I mean, even though it might only be up 1% or a little less than 1%, I mean, you're outperforming the market by 5%. That's pretty strong.
Yeah, exactly.
Very good pick.
All righty. And yours, we had mTOR, correct?
Yeah. Or we can just skip mine.
Yeah, we can skip that. Let's go ahead and look at some new ones.
Yeah, it wasn't very good. It was probably down. Hey, I got to take my medicine, my lumps when they don't go my way.
Oh, yeah.
Overall market, when the market's down like that, many stocks are going to get hit. Mine went down more than the market, though. And I think that one was down like 7% or so.
Yes. All right. Well, interestingly enough, let me just give a little background on my choices today. I did run my general PMO scan and got 0 results. And I haven't had 0 results on that scan, Tom, for weeks and weeks. So that always is a good clue that, obviously we know that the market environment hasn't been hospitable, but certainly that tells me that not much is coming out of that mire just yet. So interestingly, when I did run my other scans, I came up with utilities and let's see, I know I had, and a lot of REITs, and makes sense, right? And I even added a healthcare one in there. So let's start with American Electric Power. Nice breakout today. It has been in a consolidation zone, but you always like to see those breakouts. I would look for it to move higher. Notice that the PMO is just now getting ready to log a buy signal. Scooter is now moved into the hot zone. I'm not thrilled with the OBV right now, but that breakout is looking pretty good. And given the environment of the market, these defensive sectors should do well, in my opinion, over the next week. REITs, we have Preferred Apartment Communities, APTS. And today you've got a 52, well, not today, this past month, you saw earlier in May, I'm sorry, a 5,200-day crossover. That puts this in a long-term trend model buy position. But we've seen these EMAs braiding across during this consolidation period. And while I like the PMO and the buy signal, and I think OBV looks a little bit more positive than on that last chart, Scooter is making its improvement. We just haven't been able to get really solid, decisive breakout above these tops from February and March. I think it's time. I think we're going to see it start to make a move to the upside at this point, obviously, because that's why I picked it as my Monday setup. Not so sure, the upside potential. This would certainly be something short term for me. I'd be looking at that top as overhead resistance. So 1675, I think, would be my target here as a possible short term investment. IDACORP, and this one is also a utility. And I like the look of this chart. Look at this breakout, a little bit more impressive than AEP. And, we're on a nice rising trend. It is a little bit on the parabolic side, which I don't usually like, but the PMO is rising strongly, and there's still plenty of room for it to move higher without getting really too overbought. So I would be looking for some more upside movement here on IDACORP. You can see nice Scooter coming in there. It looks like OBV's working on an improvement here. If we get a nice update, well, I think we're going to close higher. If we get a lot of volume coming in here, I would look for that OBV to reach above that previous top, and that would certainly be a good sign, a confirmation. Kite Realty Group Trust. Again, not really sexy stocks here because they are in that more defensive area. But I got the PMO buy signal here. Again, it's moving a little bit too sideways for my taste, but I like the setup here as far as OBV Scooter improvement. I would look on a shorter term investment at that $16 or just below that as a possible stop. But I think you could look for a move to challenge this top that we saw back here in February, especially if we consider if we continue to have this kind of uncertain market and bearishness. I'm going to skip Southern Company because that's going to be my pick. Wright Medical Group, that was the other one I put in the poll for your review. PMO is just now getting into positive territory. You can see that the OBV is moving nicely in the right direction. Scooter's in the hot zone. And there's still a lot of upside potential here to that $33 level. Looks like we might be forming a bit of a flag, which of course is a bullish formation. And you would expect the breakout above 32. So I think there's a lot of upside potential here. And we're getting this 3% pullback today on it, which could make it interesting. And then notice 2050-day EMA, positive crossover happening right now. And that would give me an intermediate term trend model buy signal. So those were my picks. And Southern Company, of course, is going to be my overall pick. And that is running right now at 53.85.
All right. Well, it worked for you last week.
Yeah, we'll see.
We'll see if the utilities work again this week. I'd say right now with VIX as high as it is, probably not a bad choice, at least to start the week.
Mm-hmm.
Okay. I am going to go a little bit different direction. I got to try to atone for that horrible pick last. Let's see here. I'm going to start with, and this will be my pick for this week. I'm going to go with Kansas City Southern. So I'm going to go with a railroad stock and all of these picks. I'm telling you, I was looking. I had one in my blog this morning, which I am going to bring up in a couple minutes, but I ended up not going with it because it was right near support. And with the huge gap down today in the market, actually gapped below support. And at this point, I'm just watching to see if it reverses. Otherwise, I wouldn't touch it. And Kansas City Southern is almost a little bit like that. We are below the gap support level. We are below the 50-day. I would like this a whole lot better if we rally later today and can hold on, say close around 117 and a half, maybe 118 even. I'd feel better about this stock, and then maybe use today's intraday low as a stop. But the stock has been one of the leaders. I could pull it up here on the relative charts. And you can see, first of all, railroads have been doing very well in 2019. KSU relative to the railroads bottomed a few months ago, pretty close to a relative support level, maybe just a little bit below it. But versus the S&P, Kansas City Southern's been pretty strong. And then you can see the railroads have been strong relative to the S&P 500. So I just feel like this stock getting back down close to gap support, I think you could keep a very tight stop. I don't know that I'd give it more than about 1% from here. So I would keep it very tight and look for a reversal. And if we don't get it, I probably would be out of it pretty quickly. I do not own this one at this point, but I do like the fact the stock was at 125 just a little over a week ago. Now down to 117. It's pulled back nearer its 50-day moving average, a little bit below it, and also has filled its gap that was established back with its earnings in April. So overall, this is my pick. I will go with this one at 117.05, and I'll show you the rest of my picks. And I tell you, they were changing from this morning to just a half hour ago because of the huge move lower in the market. So some that were near support that I was looking at this morning have dropped below support. Now I'm looking at some others that have gotten closer to support. So Universal Display, OLED. If you look at this, this is a company that's really moved a lot since the beginning of January. It went from under $80 to $190 in about 4 or 5 months. Clearly a tremendous performer relative to the S&P 500, as you can see from this chart. But it has pulled back here recently. And the overall group, you can see, has been pulling back quite a bit. So I think the 150, 155 area is going to be kind of important here for OLED. If it does start to accelerate to the downside, I would be out of it. I think it is possible it could get all the way back down to the top of this gap support at 130. That's, I'm assuming, would be with the market really in sell-off mode at that point. But if the market reverses, I think this is a key area for OLED. So that is another one that I find interesting at this point. But again, I don't own it. I don't own any of these stocks at this moment, by the way. I'm looking for a market reversal, and I haven't seen one yet. Akamai, after gapping up with earnings, it was at $86 to open May, and now it is at 74 and change. It's come all the way back down to its 50-day moving average. Of course, the internet space has been moving lower. Akamai, after its earnings report, actually outperformed the internet and started to turn back up here. So even though today it's down, it's actually holding up better than its peers. And so far, I think doing pretty well. But again, this is an area where I'd be looking for a reversal. It broke out just, it was just below $74. Looks like that prior top. You could even go all the way back to the October high here, just below $74. Once we broke above it, I think that's an area we want to watch the downside. So we're at the 50-day. I think from here down another dollar or so, it's going to be pretty important to hold. Next up is the stock that I put in my blog this morning. This is BlackBerry. And BlackBerry, you know, I looked at it and I was a little concerned, especially you can see BlackBerry on a relative basis not doing very well. And so anytime I see a stock like this, I want to make sure I keep a very, very tight stop. If it's not performing well on a relative basis, and then it breaks down on an absolute basis, that can be a double negative for the stock. So I was looking for this 870, 875 area to hold, and we opened today at 860, and we're currently trading down at 843 below this support level. I would not take a chance here, but this is one that I would be looking at on a market reversal. If all of a sudden we see a big reversal and volume picks up and you close back up, say, over 870, then I think BlackBerry gets back on my radar. ACN, Accenture. It's another one that I've really been watching closely. Huge gap up, and the top of gap support's about 169. You can see the heavy volume, that hollow candle that came in there. As we move lower, I'm waiting for this area to be tested. But again, another one I think you can keep a fairly tight stop on. ITT, huge volume just about a little over a week ago on this gap up right here. We've gone all the way back down to this 59 level. I think, again, this is a level that really needs to hold here. On a reversal in the market, I like ITT. But if we don't reverse and we break down, I think next stop is down below 56. And two more. MCO, Moody's, another one that had been moving higher, coming back down, testing the 50-day. I'm going to pull this up just on a regular chart. I want to see the PPO. Probably, yeah, you can see the PPO just keeps looking like it needed this 50-day test, and it needed a centerline reset, and we are getting it because of the overall market. MCO, I think, again, at very close to a key support level. We broke out right here at about 183, 182 and a half. getting close on this pullback, sitting at the 50-day, another one that I think would look good on a reversal in the market. And then the last one is Yeti. I think I've spoken about Yeti in the past, but I do like all these hollow candles. It's telling me that even though it's gapping down, we're seeing buying interest throughout the day. Volume's been strong to the downside, but we have not lost the breakout level at $26. So I think current price down to 26 is an area that I watch pretty closely here on Yeti. And that is it for the Monday setups. It's going to be an interesting week because if we get that rebound, I like the more aggressive stocks. But if we don't, Aaron, I like keeping it safe the way you did with SO.
Yep. I'm hopeful on SO. I actually picked up a few shares. So
okay, cool.
There you are.
I didn't pick up any of mine. I got no confidence in mine. not yet. Not yet. Anyhow, all right. Well, let's move on to the earnings spotlight. And I thought what I would do today is I want to bring up a stock first. This is EHTH. It's a life insurance company. And if we go back, actually, I'll just pull it up on that relative chart that I like to use. And it's just been sideways consolidating off an uptrend. So I think the stock still looks pretty good here. You can see the uptrend here, sideways consolidation. 50 to 55 has been pretty good support. Anything, getting up around 70, 72, that's been where we've been hitting resistance. But overall, this is a stock that's been doing quite well. And when you look at it relative to the life insurance group, it's actually been performing really well on a relative basis. So when the life insurance group started to kick in back in December, this is showing that life insurance was outperforming the S&P 500. When that happened, look at what happened to the stock from December into January. It just exploded. It was one of the leading stocks in life insurance, but you really didn't maybe get too much, maybe it wasn't getting a whole lot of attention because the group was so weak. But once money started rotating into the group, you can see it took off. This stock, eHealth, was one of the top 10 picks that I had back on November 19th. It was a webinar I did at Earnings Beats. And John Hopkins at Earnings Beats, who comes on here every other Monday and joins me for Earnings Spotlight, recently started a new free newsletter over at Earnings Beats. And he's asked me to contribute periodically. And this was a chart that I just contributed today, just showing some of the attributes, some of the things maybe you can be looking for. If you have any interest in that newsletter, by the way, like I said, it's free. There is a link in my blog article today. So in addition to some of the setups that I did, there was the Monday setup. That was the BlackBerry I was looking at. You can see that range I was talking about. We gapped below it. But anyhow, some other trade setups, you can click there. But then at the bottom here, this was a link to the free newsletter. So you just type in your email address and you'll get that newsletter from Earnings Beats. And there's going to be a focus this week, I know, on relative strength. So might be a good time to sign up, take a look at that. All right. So anyway, that was the first stock I wanted to show you. But this is one that's performed pretty well over the last 5-6 months, no doubt. What I wanted to do, though, is take a look at some of the worst performers in my strong earnings chart list. I actually went back and ran a scan for stocks on my strong earnings chart list that have an RSI below 30. Now, usually in an uptrend, I don't see RSI go below 40. So these are stocks that really have been struggling of late with an RSI that has gone down below 30. So I figured what I would do is go over these with you and just see, are they toast or do they have some hope? First one is Alarm.com. Now, we just saw a big gap down. They came out with strong results. They gapped down. I included it. I left it on the strong earnings chart list, even though it had a negative reaction, because it's got a nice trend in play and mostly because it's in the software space. It's in a great group. So, if I had to annotate, I think the big level on this chart to watch is going to be that recent low, because that recent low kind of coincides closely with these prior highs here. And so you can see a lot of congestion between about 57 and 58 to the upside. And notice that same congestion to the downside, 57 to 58. And here today we get down to a low of 58.25 into that range. So I think this is a stock that you could still keep on the radar, and especially if we get down, maybe even go below 57 on an intraday basis and reverse with the market, this is one that could see a nice recovery. So I'm going to stick with ALRM for now. Next up is Garmin. I know this is another one that did not get a very positive reaction to its last earnings report. You can see the gap down, heavy volume. They beat on their top line, beat on their bottom line, though. And I think the telecom group, which has been very weak over the last month, I'm waiting for a reversal, but Garmin is one of them in this group that I would certainly keep on my radar. I think you have solid gap support, the top of gap support there at 75. We're down to 76.94. Stock was at 90 just recently when the overall group hit its high. This is a stock that's really gotten hit hard on this pullback, and we are coming up upon an area where we saw a ton of buyers at 75. So Garmin, I'm going to leave on as a potential trading candidate. Let's see. Another one would be KLA-Tencor. And remember, these are all stocks that have seen their RSI drop significantly. This one I'm having a problem with because of the huge volume. The big drop below its moving averages. The 20 now is coming below the 50, so you're getting a death cross, heavy volume. And this is an area of the market that is prone to a lot more weakness if this trade deal doesn't get resolved. So I'm going to pass on KLA-Tencor. I've been a fan. I was definitely a fan of the semiconductors, but they are taking among the biggest hits on this trade deal or lack of deal. So I'm going to hold off on some of these semis, especially one like KLA, which has lost its moving averages and done so on heavy volume. Next up is APH. This is Amphenol. After gapping down with its earnings back in April, it rallied back. Now it's started to roll back over again. I don't like losing this 92 level today, and I don't like all the volume coming to the downside. So this is one that I would probably pass on. I think things have changed now. I really like that hollow candle off of the big selling at the open, and then they rallied back. But that's an area that should have held. And not only have we lost the gap support from over here, but we lost that 95 support. And then we even lost this support from March. So not looking good. I would pass on APH. PWR, Quanta Power, or Quanta Services, is this one to pass on? I'm going to say yes. It's one that I would pass on. I don't like the fact that the stock now from 41 is all the way back down to 35, below its moving averages. And again, the volume picking up. And the overall group relative to the S&P really wasn't that powerful. It was strengthening throughout the first 4 months, but it was nowhere near its high that it seen back in the fourth quarter of 2018. So I think the fact that the group is rolling over and this stock is falling so quickly against its peers on big volume, I find it difficult to argue in its favor at this point. All right, how about GTN, Gray Television Network, or Gray Television? I think this is the level. I could be okay with this one, mostly because it has been in the broadcasting and entertainment group, which is still one of the best areas in the market, continuing to strengthen, by the way, versus the S&P 500. So if I'm going to take a shot on stocks, I like to do it with groups that are still holding up well. So the stocks lost some steam, but I believe the gap support should come in between about 1880 and 1920, and we're currently trading at 1896 off of a recent high 1 month ago, a little over a month. Well, no, 1 month ago, over $25. So this is a stock that's down almost 25% and at a key level. So a reversal, the candle that we saw 2 days ago, if I saw that candle with a long tail down below the support and a recovery, that would maybe get me involved in this stock, something to keep in mind. But, as Aaron and I were alluding to just a little bit ago, when volatility is high, sometimes you are better off with some of the more defensive names. SSP, this stock was getting hammered earlier today. So let's see if it still is. I imagine it is. Yes, it is. I can't get behind a stock that looks anything like that. That is a huge red candle. Opened at 21. It's now at 1760. Volume is accelerating. We're at the halfway point of the trading day. We've done 550,000 shares. So we're going over 1 million shares today, likely. And you can see that is not light volume on this chart. So don't know what the news was here. Didn't see it on the downgrade list. I don't know if there was news out or not, but this is a stock that's getting hit very hard, down 18%. This isn't just going down 3 or 4% with the market. This is going down a lot. And I would not try to catch that falling knife. Zebra. Now, I pointed this one out, I think maybe last week in Monday setups. I think this one is at a level I'd be watching pretty closely. If you annotate here, I believe the breakout level and gap support right there and here. Look at the volume that came in February from about 187, gapped up from 185, multiple highs around 185. Stock was at 235, and through all this selling has now come down and tested this area. I'd be looking for a reversing candle here. This is one that I could get behind. Crocs. What a tumble we have seen here. Another one, that was a bearish engulfing. And at the time, I thought, okay, well, when it pulls back, especially if we're to get back to this level, 24 and a quarter, that seems like pretty good support on this stock. But we have barreled right through it. And not only that, but we have seen there's that support level there. There, you can even go down to the intraday low here. You can see we're going through all of it. Look at the volume, and also look at the footwear stocks versus the S&P 500. So over the last 2.5 months, we've been downtrending on a relative basis. We've been downtrending on an absolute basis here in just the last month. But on a relative basis, the group has been struggling for a couple months, over 2 months. So I think given all that, the high volume, the breakdown, I mean, you might consider one more level there being the bottom of gap support, but this one's starting to get stretched to the downside. I probably would avoid it. PVH, 2 more to go here. PVH moving lower. This is one I probably cannot get behind. It was starting to strengthen. It had some nice volume, very little follow through. Now we're starting to roll back over again. And I think the key is to look at what the clothing and accessories group is doing relative to the S&P. We barely got a breakout. We were starting to show some nice strength in the middle of April, and we quickly rolled back over. We are now at about a 6-week relative low in the group. And you can see the stock relative to its peer groups, or its peer group in the clothing and accessory area, not doing well. So I think this is one that I would pass on. If there was one level maybe to consider taking a shot, it would be the bottom of gap support that we are quickly approaching. But I don't think I like the way it's behaving. I don't like the way the group's behaving, so I would pass. And the last one I had is Momo. Like the ticker symbol, don't like what's been going on, though. This one just is straight down, continuing to gap lower. It tries to bounce off of those intraday lows and then just continues to move lower and lower. It's really not that far from that December low. And even though it's in the software space, look at what it's doing on a relative basis, back down near a 52-week relative low. Hard for me to get behind a stock that's in a great group and performing the way it is right now. Software, by the way, has not been doing that bad within technology, not nearly as bad as computer hardware and the semiconductors. So it's in a group that's actually been holding up pretty well, and yet it is just not doing well at all. So I can't see anything really to get behind here on the chart. So I would avoid Momo. And that concludes all of the earnings spotlight stocks I had for today. You can see them there. just because I put these stocks on my strong earnings chart list doesn't mean they always stay strong. And you can see just by taking a look at some of the weaker ones, I would say several of these stocks are stocks that I would no longer be feeling comfortable trading. It might be that something is going on in their business model. Wall Street is visiting with the companies, finding out that things aren't progressing quite as well as they should. And as a result, that might be why stocks like Momo were moving so much lower here over the last week or two. All right, Aaron, it is time. 10 in 10. You got the RRG up?
You know it.
What you got?
All righty. Here we go. All right. So I was just in the process of trying to get this in a little closer so I could get a better look at some of these. GoGo looks interesting. I know I've got that on the list already. And then as far as the sectors go, comm services, healthcare, technology seems to be the winner for sure. A lot of semiconductors. So we're going to look at one or two of those. All right. So let's go ahead and get started with the first one, which is Black Hills Corp, BKH.
All right. Yeah. Anytime you got a stock that's moving up in this kind of a market, it's hard to argue. You got the PPO, which was at centerline support, now turning higher. I think that looks really nice. Volume has been pretty strong on these moves to the upside, also a positive. And you've got your 20 above the 50 on the pullback that we saw on Thursday. We held on, actually established the other level of support because that was the low before we made the move back up to break out again. So I would just say in the short term, you got some pretty good support between about 73.50 and 74.50. You got the rising 20-day moving average sitting at 73.50. This one I think looks pretty good. And on a relative basis, if I go into the relative chart here, you can see that it is in the utility area, and this group has been doing pretty well. And overall, BKH relative to the S&P just broke out, triple top breakout, and relative to its peers. So you got one of the leaders in a group that's being favored right now, one of the defensive areas of the market. So hard to have too many bad things to say. It's not going to be a huge, probably not going to be a huge money winner. But if it just maintains your capital and makes you a little bit of money and when the market's going down, there's a lot to be said for that. So looks good.
All right. The most popular in the chat room, and I overheard you talking semiconductors, but what do you think of AMD?
Yeah, AMD, I'm a fan of still. It's holding on. Intel, KLA 10 core, many of these semiconductor stocks over the past week or two, we've seen some real big drops. I think AMD's hanging in pretty well, and it shows up in their relative chart versus the semiconductors. I mean, it's hanging in. So my guess is that if we get a bounce and the market puts in a bottom and we start to get a nice surge to the upside, I suspect AMD is going to be a leader. It's been a leader to the downside. I think it could be a leader back to the upside. So I'm going to annotate and just kind of watch these recent lows. I don't care how good a stock's performing. You can't just say you're going to hold it no matter what. I think that's an area that I would watch pretty closely. We've been holding over the last week with the market getting hit hard. We've been holding in this 26, 27 area. So I'd keep a fairly tight stop. If it breaks below that level, I think you could be looking back down where you had a lot of the buying coming in on this candle, which would be down just below 74. Maybe that recent low there, 24 and a quarter or something. But I'm going to get some of these out of here so it doesn't get too confusing. I just think in the short term, I would want to watch this 26, 27 area.
Okay. Excellent. Next one up is from, it's the only financial sector request, and that would be Square. We haven't looked at that in a while.
Yeah, I was thinking Square might get a pop into its earnings. It did not. It gapped down, and it continues to move lower. Look at the relative weakness here. There's just one thing you need to see on this chart that tells me that I don't want any piece of it, because the group itself, financial administration, has been pretty good. But when you look at the relative strength, or in this case, relative weakness, I don't think there is any doubt what this is telling me. It's telling me you do not want any part of Square. If you're looking for this group, a stock like PayPal, I think has performed much better. Square, I would definitely, I can't really support it, I guess.
You pass.
I'm going to pass. I mean, I actually think this is a stock that potentially could go down to that December low It's got about another 20% to go, but the rate it's been going wouldn't take but another week or two to get there.
Absolutely. I don't like that chart. Absolutely. All right. Let's see. Well, let's see. Medical Properties Trust. Let's go into the REITs, MPW.
Okay, I expected that we'd have a little bit better looking chart, and we do. The group overall has been pretty good. It's been solid relative to the S&P 500. In fact, that's an area that is trying to make a breakout on a relative basis. Whoops, that's not what I wanted to do. Right down here. So you can see those highs. It's been holding pretty steady. May has been a great month for the group, and it is getting close to a relative breakout. So the good news is if you're in this stock, number one, it's held price support. There was your prior high in December. Broke out. We went right down there. Looks like we might have gone just a tad below it. Actually, I might even have this line up just a little high. There you go. So I'm going to say 17 is great support. Short term, we need to get back through about 1820. I think that's your trading range for now. But because the group is strong, if we get that relative breakout, I would suspect MPW is going to make this breakout as well. So, been down a little bit from the high that we saw in April, but I think relative to what the market's been doing, you got a pretty good one here.
All right. I like this chart. I'm curious what you think. GoGo.
Well, on the RRG, it certainly looked good. So let's take a look at GoGo. That's another one, kind of rhymes with Momo. I like it, but this is an area I'd be careful because this is where we saw all the sellers come in on the gap down several months ago. So I like what's been going on, but this is when all of that heavy selling started at 570, and you can see today's high was 567. So this is what I would do. Let me look at the relative strength. It's definitely been picking up, but its overall group, this is part of telecom equipment. It's been going down. This is a group that's been struggling, but GoGo on a relative basis doing pretty well. If we can get through this 5.7, and I would say even all the way up to the $6 level, that's where it traded up that day on heavy volume before we saw the big reversal. But volume's been picking up on the way up. I would just say this, because the group is struggling and because there are some overhead resistance obstacles here, I would want to make sure that rising 20-day continues to hold. So as long as I'm in it and it's holding above the 20, I'm okay. I want to see it get through that $6 level, and I want to see some volume coming in. It might need a gap. It might need some news or something to get above $6. We'll see. So I agree with you. In the short term, I like it. Longer term or maybe intermediate term, let's see if we can get through that $5.75, $6 level.
All right. And this one is in conventional electricity. I have to say I like my Monday setup pick way better than this chart. Dominion Energy, just D.
Okay, D. Yeah, I would agree with you. This one, because it's in a strong group, I'm going to give it a little bit of leeway. It could just be sideways consolidating. So I'm going to draw a couple of lines here. That was that was the February selling that we saw, which we went down and tested. So now we got two levels, or two times we've gone tested that level of support. Recent high up near 78. So that's the trading range that I'm going to suggest that we follow. To the upside, we've got to try to get back through that 20-day moving average. So after breaking down below the April low and now moving back up, I think we need to get back through that 20. If we do, then that's kind of telling me we're just sideways consolidating, because moving averages don't tend to do anything in a directionless chart. If it fails at the 20 and starts moving back down, it's starting to act more like a downtrending stock. So I'm a little bit mixed, but I like it's the area of the market that it's in. So I'd hang on at this point if I was in the stock.
All right. The next one of our viewers said it would be their Monday setup pick, Catasys, C-A-T-S, CATS.
All right. Can't really argue. It's a nice chart. There is some liquidity issues on some of these days. Recently, it hasn't been as bad. But yeah, I love this sideways consolidation. In fact, I could probably draw a nice little ascending triangle coming across here. We set a high, went up and tested that high over here, and you can see that the lows were getting higher. I'm not going to say it's a perfect ascending triangle, but it's certainly one that's got higher lows and equal highs coming across here. After breaking out about 14, we went back and tested that along with the 20-day moving average. That's what you want to see. right there. And so I agree. I think this is one that looks pretty darn good to me. After breaking above 14, we set a new high at 16, tested 14, and broke out back above 16. So I think short term 16 would be your support level to watch. But yeah, this one looks good. Liquidity, a little bit of a concern for me, but the chart looks good.
All right. Let's see, next one up from the publishing industry, Thomas Reuters, TRI.
Yeah, this is one I just added recently to my strong earnings chart list. It's been going straight up. The group has come down, which means on a relative basis, you got one of the leaders, which is awesome. But the group is just broken to a multi-month low. So with the weakness that I'm seeing in the group, what that simply tells me is that if I'm going to trade it, I want to make sure I keep my stops tight. So I'm going to probably continue to look at this 20-day moving average. We haven't even tested it really in a while. We got close a week ago. But I think as long as we stay above the 20-day, I'm okay with TRI. But if we fall back below the 20, given what the overall group is doing, that's where I would have some issues. So I would watch that rising 20-day moving average.
All right. You know what? Let's look at a bond ETF that we talk about a lot, TLT. I know I'm feeling pretty bullish on it still.
Well, yeah, it's hard not to, given what's been going on in the Treasury market. Prices keep going higher, yields keep going lower. I think you have, I don't need the relative chart, so let me pull up on a regular chart here. And I do want to go back a little further. But I think off of an uptrend, you got a cup. I mean, this is almost a textbook cup. So here is the uptrend. You could start it here, or you could even start it there. Either way, you got a nice uptrend in play. And then it certainly looks like a rounded kind of a cup to me. So using that parabola tool right there, right here, and then where we are now, that looks like a cup to me off of an uptrend. So I'd say that we're in a bullish pattern. Still need to get a breakout. We may struggle here at about this 126 level just because that's where we saw some selling before. But unless we have something huge, I mean, we could pull back maybe to 124. But short term, I would view that as an opportunity to get in. So, yeah, I like it.
All right. Let's look at a software company, Ansys, ANSS.
All right. I think this is the last one.
Yes, it is.
Well, this is looking a little bit like some of those I looked at for my Monday setups earlier. I think it's just getting to a point where it really needs to turn. You've got gap support right there. Go back to April. That wasn't really heavy volume, though. Yeah, I think we've had multiple tests down here at around 184, and we've left tails down there, meaning that buyers have come in there. Currently, we're sitting near the low. So are the buyers going to come back in again this afternoon? We're going to find out. If not, I think next level would probably be down where we tested twice in March down near 175. So it could be another $10 drop if we don't hold 184, 185. So that's what I'd be watching on ANSS.
All right. And that does complete the 10 and 10. Here are the symbols that we just went over. I will get these in the Market Watchers Live chart list so that you can download them and look at them and annotate them as you wish. Just go to the Articles tab, click on the Market Watchers Live blog, and the link is right there at the top. All right, let's go ahead and get started here on our final market update. But before I get started on it, I do want to let everybody know that we are still running our spring special. And actually, I think I need to update this. We have extended it to Monday, May 20th. So you have a week and you can get all the information about this new special and Stock Charts ACP. If you didn't see Friday's show for the demo of our advanced charting platform, highly recommend you go find it on YouTube and check out Chip's demo of this new charting software that we now have available that's coming out. All right, but what is going on in the market? Here we go. Not good. Still making intraday lows here for the Dow and the S&P. Notice NASDAQ and New York Stock NYSE following suit. Small caps, same. Right now, the Dow is down over 690 points, and the S&P is down about 77 points. TSX, as you can see, we got the big gap down, but Canadian markets seem to be have hit their intraday low and are trying to come back up and take back some of those losses. Treasury yields are lower, reading 2.393%. The VIX is much higher on the day. We're seeing a reading of 21.22. UUP, you know what? We started down with the dollar, managed to come back up, but really not able to get into positive territory. Currently, UUP is unchanged. Gold, big gap up and continuing higher. USO, my goodness, talk about a steep cliff here. Big move to the upside in the morning and just a steady and quick decline. We're now looking at USO down 1.3%. 2% at 1267. TLT gap up and moving higher. And that is it for the candle glance. Let's look at our summary here for the sectors. And not surprising, number one, to see utilities leading. But notice it is the only positive sector. And the next one up, which is REITs or real estate, that one is in second place here, but it is down equal and opposite, down 0.53% for real estate. So really we're seeing some suffering across the markets. The only ones that are actually seeing some favor today are utilities. That's all I have. I'm going to pass it back to you, Tom.
All right. Yeah, I wanted to bring up, you mentioned the dollar, so I thought I'd just bring the dollar index up here, US dollar. And you can see over the course of about the last 2 weeks, we have been moving down a little bit. Certainly nothing major, and I still believe the uptrend is in play. But while we've been moving down, it has given energy on a relative basis a little bit of a boost. Materials, not so much. I mean, when we topped here at 98 on the dollar index, you can see that the XLB relative to the S&P 500 was at a really critical relative support level here in 2019. And even with the dollar moving lower, we still broke down below it. So I'm not sure what it's going to take to get the materials moving to the upside at this point. Even the slightly weaker dollar over the last 2 weeks has done very little, although we are getting a little bit of a pop here the last day or two. So this is something to continue to watch, keep an eye on. But if the dollar starts to strengthen again, I would suspect that this overall downtrend in both of these, the XLB and the XLE, when you look at both of these on a relative basis to the benchmark S&P 500, it's not good. And I suspect with the dollar, if it continues moving higher, we'll continue to see underperformance from these two sectors, which is exactly what we've been seeing for about the last 8 years. And that's all I have. And I'm going to turn it back over to you, Erin, for sentiment. I'm interested to see what your sentiment shows.
Yes, it is rather interesting right now. So let's go ahead and get started. All right, this is your Decision Point Sentiment Update for May 13th. We'll be looking at various indicators, including the 10-day moving average put call ratio, AAII, which is the American Association of Individual Investors. You can go to AAII.org and take their survey to see if you're a bull or a bear or neutral. National Association of Active Investment Managers. We keep track of the exposure for active investment managers, those money makers, those money managers, I should say. RIDEX ratio is a decision point indicator. I'll talk about more when we get there. Wall Street Sentiment Survey is a weekly market timers survey. Then we will also look at the VIX, which of course is a sentiment indicator. And then I will finish off with gold and look at gold sentiment right now. All right, so let's go ahead and move on to the charts. Here we are. Okay, so the first one I'm looking at is the 10-day moving average of the put-call ratio for CBOE, equity, and OEX. And what I wanted to point out at this point is, as you can see, it's been getting higher and higher as far as the reading. I invert my scale because as it gets higher, that means we're getting oversold in my estimation. And what I wanted to note is that, you know, when we're in a bull market situation, you could see it through here and through here. We tend to oscillate here on that 10-day moving average. It just tends to stay in this particular range. And notice we're now near the bottom of the range, but the acceleration is not letting up. I would expect that we're going to see movement down below the regular range for a bull market. So I'm watching that closely. If you're looking for more downside here, or I should say upside, if you want to say, when you're looking at these readings and seeing them increase and increase, of course, that means you're getting more and more oversold. The fact we're not seeing any deceleration here has me concerned. I would expect to see it continue lower. And it continuing lower generally means you're going to follow that price further down. What we want to see we would love to get a bottom here on these put call ratios. Typically, when you get the bottom, that's when you start to come out of your negative market situations, that kind of an environment. But right now we're accelerating downward. Does not look like we're going to stop here at the bottom of what the bull market range would tell us is oversold. So I would continue to look for those ratios to move lower. AAII, as I said, you can go to AAII and take their survey if you are a bull, a bear, or neutral. And we watch these readings. One of the important parts of these readings is the actual ratio of the bulls to bears. But I'm going to come back to that in a moment. Notice in the thumbnail, because it's a lot easier to see what's been happening with this indicator, but you can see that we're getting more and more bulls in the survey. And in fact, have reached a level that we haven't seen in 2019 as far as the amount of bulls. Sentiment is contrarian. So when people are feeling more and more bullish, that tends to be bearish for the market. We are seeing a slight increase of bears, but as you can see, very, very low reading. And so you combine these two readings, and that's what gives you that bull-bear ratio. When you see a reading of 2, of course, that means you have twice as many bulls as you have bears. So that's really that threshold I'm always looking at. But you can see we're still very elevated. We're getting very close to that. And the fact that I am seeing more bulls right now than we've seen all year on this particular indicator, that to me is a red flag, and that would tell me to expect more downside. That's my thoughts on that one. And then I've also marked where we've had these excessively high bull-bear ratio readings, and they do tend to show up at the right time, either in front of some consolidation or before a decline, as you can see in these cases. But then, you know, hey, sometimes it's only a little bit of a pullback, and then we can make our way back up. But with the market being weak and having that high volatility, I think we're certainly vulnerable to more downside here rather than a bounce. Next up is name exposure. Again, these are the active investment managers, and they report to us how exposed they are to the market. And right now we do have elevated readings, but I don't really see these as out of the ordinary. And you can see exposure has been pulling back despite price moving up. So to me, that tells me that the big market makers are looking for something. They were expecting some sort of a pullback or a decline because their exposure started to move lower. It's now moved quite a bit lower from last week. But it's still rather elevated. They're still they're still exposed to the market enough that I wouldn't call this, you know, a huge pullback or suggest that they're especially bearish or anything like that. I really would look at this as more of a neutral to bearish reading because it is elevated, but more to the neutral side. I just would pay attention to the fact that these guys do tend to know what's going to go on in the market. Usually following the exposure is a good thing because it comes in early. They usually tend to be on top of things a little bit earlier than the rest of us. And so there you go. We can see that pullback in exposure, and that should be giving us a little bit of concern. Wall Street Sentiment Survey. This is a survey that I take every week along with Carl. In fact, let me move this to the right chart because that's not the right one. There we go. All right, and this is, yes, this is the up to date. All right, so the Wall Street Sentiment Survey, and you can read more about it at Mark Young's website, wallstreetsentiment.com. And he sends out an email survey to market timers and asks us whether we think that the next week will be bullish, bearish, or neutral. And so we give him what we think on Friday afternoon. And the pool of pollees is actually closed. I mean, it doesn't change very often, so that really, I think, gives this particular indicator some weight, because you're not constantly mixing up the components of who's taking this survey. So the things I want to point out here, first of all, over half of the market timers were bullish coming into this week. And I was actually on the bull side coming into this week, just because I was expecting to see a little bit of a bounce here. Of course, waking up this morning, as Tom said, and seeing the market taking a dive and seeing the VIX starting to really increase, I have to change that stance. But at the time, it seemed that we were ready for that move to the upside. The VIX had moved right back up towards its moving average. So I felt like that was a good time to come in bullish. And I guess a little over half of us did come in bullish, but a third came in bearish onto the week. So looking at the bull bear ratio, which is what we looked at earlier, right, on the AAII, we're almost to 2. So we're seeing another very elevated bull bear ratio reading, not quite to the twice as many bulls as bears yet. And you can see quite a bit of a pullback on the bear reading from this week versus last week. And seeing that sort of a move to the downside on the bears coming in, I think add that to the slight increase in the bulls. And market timers did, in general, come in much more bullish, but that elevated that ratio, and that does make us vulnerable to more downside, really, this week, based on the Wall Street Sentiment Survey, anyway. All right, let's go ahead and look at the RIDEX ratio chart. All right, I always give the explanation before, so most of you who watch this can turn your ears off for a little bit. The RIDEX ratio, what it came about, Carl found out that the RIDEX company that was managing these funds would report their assets in each of the funds every evening. And that if you tracked those assets in the bull funds and sector funds, and you track the assets in the money market and the bear funds, you could actually come up with a ratio based on the amount of assets, the money that's going in and out of these different funds. And so RIDEX was since taken over by Guggenheim, but we maintain the RIDEX name for posterity, I guess, but also that's the name we gave it at the time as far as an indicator goes. So the RIDEX ratio is what we're looking at right now. But first, I'm going to start us off with looking at where the asset flows are going here. And as far as the bear funds, we're starting to see that pull back on the assets in those funds. It's really been quite flat, but it's still technically decreasing somewhat. Notice that money market funds, we're starting to see more assets moving there, and equity funds, big pullback, a lot less on the bull funds. Now, when we look at that AAII poll, for example, and remember we had almost twice as many bulls as we did bears, that's that finger in the wind versus actual money, because there were a lot of bulls coming in on sentiment, but what happened? Equity, sector bull and sector funds lost assets. They came out, money was pulled out of there, and so despite saying everybody, saying they were bullish, as far as the market participants, they actually, with their money, pulled back. And so that's why we like this chart, because it does show us money where your mouth is, sort of thing. Right now, as far as the RIDEX ratio goes, it's still very, very low. This is an inverted scale. So typically the higher readings will lead to declines. On the scale anyway, they're lower. But then the higher readings, but the lower the bottom of the scale, because everything on the bottom should be oversold and everything on the top should mean overbought. That's why I invert. So anyway, we're near the top of that range, very low reading levels here on the RIDEX ratio. And so that to me suggests an overbought situation as far as that indicator goes, and the next way is down. So at this point, I think that the RIDEX chart is showing us more neutrality, honestly, than anything else, because we're increasing. People are getting out of the market. They're not going to the bear side, but they're not going to the bull side either. They're just simply pulling out. That's scared money, somewhat scared, but not completely, which is why I think there could be more downside in the future. All right, let's look at the ultra short-term indicators that I follow every day. And looking at these last Friday for the decision point show, this was why I did end up going in bullish for the week. We had the Bollinger Band was punctured to the downside on the VIX. Typically, you get those punctures. It's the beginning of a move to the upside, but it persisted. We continued to move lower. The VIX continued to get higher and higher, and now you can see the Bollinger Bands there's a lot of space here. Obviously, it tells you there is an increase in the volatility of the range here. But we had popped right back up and we're getting near that moving average. So I was thinking that it might be a good time to see a little bit of a bounce. It was looking like we could do that today, but trade concerns and various other problems, we're seeing the VIX increase again and puncturing that lower band again. So when you get these really high volatility situations, these kind of readings can persist for some time. You can't just, lay your hat on them. That just because we got that puncture on the downside that we're going to see that move to the upside in the market. We didn't have accompanying climactic breath readings on Friday. I was hoping to see, some readings that would be closer to the high side of readings that we had previously on the net advanced decline and the net advanced decline volume. We didn't really get that. So it was sort of half-hearted. Yeah, let's go in bullish this week. And certainly things can turn around. Today is so far a pretty rough trading day, but maybe once the dust clears, we'll see something better later. All right, excuse me. Let's go ahead and look at gold and the gold sentiment. So the sentiment we determined by using the premium and discounts on the Sprott Physical Gold Trust. You can read more about this in Chart School, but the higher your discounts are, that means the more bearish the environment is on gold. And if you start getting that move to the other side, the lower discounts, or even on premium side, that is very bullish as far as the sentiment goes. So we've been in a really bearish sentiment position, and that's really set up an environment to me for gold to start doing well. We were all paying attention to the head and shoulders that looked like it had formed on gold, but then what has happened? I saw the execution. We all saw the execution of the pattern as it moved down, but then it just didn't want to give us a decisive move. We certainly it didn't seem we were going to see the height of this pattern to the downside. The PMO started to turn around, and then I spotted a descending wedge. And these are bullish patterns. Today we got the breakout to the upside, so at least I got one of those calls right. All right, so that concludes the DP sentiment report. Let me give you a quick look at the summary here. So at this point, neutral to bearish as far as the 10-day moving average of the put-call ratio. I'm looking bearish for the market on AAII, neutral to bearish based on the NAME readings. Wall Street Sentiment Survey, I think, tells us we need to be bearish for the week. See a lot of bear in there. RIDEX ratio, neutral to bullish for the market. You're seeing that scared money, so it's moving out of the market. People are starting to get bearish, so that's why I would moving it to neutral to bullish for the market based on where the money's going. Breadth and VIX, we're still seeing those lower Bollinger Band punctures. Usually that's bullish, but with this increase in volatility, I think it tells you caution ahead. And gold sentiment discounts are high. That PMO buy signal's in place, and now we're getting an executed bullish wedge. So I'm looking for gold to do better, and of course, it usually tends to do better when we're in a difficult market environment. All right, Tom, that is it. I think we probably should look at the poll, right?
Well, we got a couple minutes, so I thought maybe before we got into that, we'll take a look at the. There's a story out on Qualcomm. So
yes.
I wanted to bring this chart up here because I got a little bit of a bone to pick. Not with you. This is with the
I read the same
market.
story this morning. I was curious what your take was.
Yeah, I mean, it came out that Qualcomm's executive team has received big bonuses for settling their bitter multi-billion-dollar legal battle with Apple. And so their CEO, I don't know if I'll pronounce this right, but Steve Mollenkopf, he saw the biggest reward. He was granted almost 41,000 shares of Qualcomm stock at $85, which was Friday's closing price, 85 and change. That came out to $3.5 million that he got as a bonus. Now, I mean, obviously, you can see the move to the upside. And all these executives have stock. They have ownership in the company. So they're already getting a bonus based on the price going up. All the guy did was he did his job, which was to try and settle this dispute. I don't know. Maybe I'm crazy, but I just think sometimes, and I think that's part of the problem. I think that there are a lot of people in this country that just say, you know what, pass it along to some of the rest of us.
Right. Now, well, I have to say, I think I did back of the napkin. My husband and I have been talking about something like this. We did back of the napkin that Sam Walton, if he took all of his salary and divided it amongst all of the employees, it would give them an extra $10 a year. So yeah, I'm not trying to make a political point or anything, because we definitely don't talk about that. But it just was kind of interesting because it doesn't seem right. I have to say. I mean, you're right. They do already own a ton of that stock, and seeing it go up that much, that's already your bonus, right?
I think so. I mean, part of it is creating value for shareholders. Part of it's doing your job. Part of it's creating value for shareholders. I think they're getting their bonus, like you said, from that. So I don't know. Maybe I'm upset by the market being down 700 points.
Yes. Yeah, it's going to be, we've probably just started up a bunch of chatter. We'll love to hear it at MKT Watchers on Twitter. Curious what you're thinking.
All right. Well, there you go. There's our poll for today. And everybody's paying attention now to your picks, Aaron, because you had that nice utility last week. So they're jumping on board your SO.
Hey, before that, I had Mod N, if you recall. That was a pretty good one, too.
Yep. You had a couple good ones.
All right.
And Hershey's, which was picked by our producers, is on the list, and that one is the number one. If we were going into February, I'd be all over Hershey's.
Yeah.
There's actually a pretty interesting seasonality on Hershey's for the month of February. I think it's been up 90% of February's over the last 20 years.
Oh my gosh. Valentine's Day, I guess, right?
Yeah. All right. Anyhow, there's our upcoming schedule. I tell you, this is going to be an interesting week for sure. Got the volatility on the rise. I'm really interested to see how that equity-only put-call ratio comes out today, because I got to believe that it is spiking with all the selling that's taking place.
Yes. And that would make it more oversold. So I would like to see that.
Yep. All right. Well, let's go ahead and wrap things up. I want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's located below the video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Monday afternoon, everybody. Hopefully the market picks up later today. We'll see you back here tomorrow. Happy trading.